Welcome to This Explainer. Today, we're taking a massive step back to look at the big picture. We're going to connect everything you already know about finance, banks, debt, markets, companies, and governments to reveal the invisible machine that literally runs the world. And more importantly, we're going to uncover the single, surprisingly fragile fuel that keeps this entire machine running. Spoiler alert, actually, scratch that, I'll just tell you, it's not money.
Okay, so let's start with the foundational rhythm. The simple, everyday loop of waking up, going to work, and earning your money. We all do it, right? And it feels pretty straightforward.
You receive that salary, pay your rent or your mortgage, cover the bills, and maybe save or invest a little bit for the future. For most of us, this feels like a completely closed personal system. It's just you, your employer, and your static bank account balance.
But here is where the illusion breaks. Because when you spend or save that money, it doesn't just sit still in a vault somewhere. It moves. The very moment you make a deposit or swipe a card, you're instantly connecting yourself to another person, another business, another institution. You are kickstarting an enormous, globally connected engine.
Let's see how this engine actually builds. Step 1. Your simple deposit goes into a bank. Step 2. The bank uses its balance sheet to magically turn your dormant money into active credit by providing loans. Step 3. A business borrows that exact credit to, say, build a brand new factory, hire new employees, and spend money in the real economy. Those new employees then deposit their salaries back into the banking system, and the cycle expands economic activity for absolutely everyone. One transaction literally creates another. It's like a giant perpetual motion machine.
Now here's the catch. The exact same credit that fuels all this wonderful economic growth simultaneously creates debt. It's a perfect mirror image. On one side, you have the borrower's obligation. They owe money. On the flip side, you have the lender's asset. They expect repayment. One person's liability is quite literally another person's wealth. This means the more debt the system creates to grow, the more tightly connected and, frankly, reliant on each other everyone becomes.
But as you can probably guess, those deep connections carry profound risks. So when does the machine break? Well, it usually comes down to three things: too much borrowing, too much leverage, and unbridled optimism. See, debt allows us to pull money from the future to spend today. But when that future finally arrives and someone suddenly can't repay their obligations, the gears of the machine start grinding to a brutal halt.
And because financial institutions are so deeply tied to one another, a failure rarely stays isolated. A local problem rapidly, and I mean rapidly, becomes a global crisis. Imagine a local bank facing massive losses on bad loans. Suddenly, investors panic. Credit freezes up completely, making it harder for entirely unrelated businesses to get cash. Markets tank, and fear spreads like wildfire. Just because one bank owes money to another, and one investor holds assets connected to another market, a seemingly isolated issue can tear through the global network in a matter of days.
So who steps in when the alarms start ringing? During these panics, central banks, governments, and regulators act as the ultimate first responders. They try to influence interest rates to make borrowing cheaper, pump in emergency liquidity, and create new laws, all in a desperate attempt to maintain stability. They're essentially the mechanics trying to keep the engine from overheating and exploding.
But here is the terrifying, or maybe awe-inspiring truth. They can't control every investor or market. The system is simply too large, too complex, and way too interconnected. Capital now flows endlessly and instantaneously across international borders. I mean, a change in interest rates in one country can move billions of dollars across the globe in milliseconds. The world economy has evolved into one giant, wildly unpredictable network.
Which begs a pretty important question. Who actually makes up the shareholders of this massive global network? The answer isn't just rich bankers in suits. The owners include pension funds, mutual funds, insurance companies, and massive institutions. But if you trace that ownership chain deeper, right down to the very bottom, you find individuals, millions of ordinary people saving for retirement, investing for their kids' college, just trying to protect their futures.
There is, however, a stark and fascinating contrast between ownership and control in this system. On the capital side, we have ordinary savers and pensioners who ultimately provide the real money that fuels the machine. But on the decision side, entirely different entities. Institutions and asset managers actually control where that capital goes. So the people providing the money often aren't the ones deciding how it's used, and the people pulling the massive levers don't personally own the money.
This separation is exactly where the invisible network of power truly becomes visible.
Okay, let's take a breath and think about this for a second. With billions of people, thousands of institutions, complex international borders, and literally trillions of dollars flying around every single second in this invisible money machine, what keeps it from falling apart? Seriously, what prevents this massive, complex web of debt, credit, ownership, and control from just collapsing in on itself?
Here is the crucial realization, the whole point of why we're exploring this today. Money isn't just money. It is trust. This cold, mechanical, multi-trillion-dollar machine isn't actually powered by math or gold or even physical cash. Modern fiat currency and credit are completely immaterial. They are literally just ledgers of human belief. The entire engine is fueled 100% by confidence and trust.
Think about why this trust fuels the system so perfectly. A physical banknote? It only has value because we collectively trust the government that issued it. A loan only exists because of a fundamental belief that a borrower is going to repay it in the future. A stock only holds value because investors trust the future profitability of that company. When trust is high, credit flows and the economy absolutely booms. But when trust disappears, the machine slows down, seizes up, and breaks. The entire financial system is, at its core, nothing more than an ecosystem of human belief.
Once you understand this, absolutely everything shifts. When you stop seeing money as just static numbers in your banking app and start seeing these hidden, immaterial connections, a really profound realization hits you. You aren't outside the financial system looking in. You are living inside it every single day. The company you buy your morning coffee from, the mortgage on your house, the taxes you pay, they're all active live wires in this massive network.
Every single decision you make is a connection in this vast network, which leaves us with one final, vital question to ask ourselves as we look at the invisible machine all around us. What happens if trust disappears? If the entire world is connected by a surprisingly fragile web of confidence, what's your role in maintaining it? And how would your daily life change if that confidence just vanished? It's something you simply can't unsee once you realize it. Thank you so much for joining me on this explainer. Keep asking those great questions, and I'll catch you next time.